Hi everybody, this is Ellman, the Blue Collar Investor. In today's video we're going to discuss earnings reports and why it is critical for covered call writers to avoid them in a particular contract cycle. In my first book, Cashing In on Covered Calls, I devote an entire chapter to why it is important not to sell covered call options when there's an impending earnings report coming out. Now today we're going to discuss how implied volatility affects our option premiums prior to an earnings report. Implied volatility basically tells us what the market is anticipating in terms of the price change of the underlying security. And you'll see that prior to an earnings report, the option premium is much greater because the implied volatility is higher. That means the market is anticipating much greater price changes, but it does not tell us the direction of those changes. It just tells us that it's much greater in either an up or down direction. Now what this will do is it will enhance our option premium, which may on the surface appear to be a positive, but it'll also increase tremendously our risk in that particular investment. And covered call writing is a conservative strategy, and we do everything we can to avoid the risk. I also want to show you a chart that I constructed that explains why the upside prior to an earnings report is capped, whereas the downside is not. So what we're going to do now is let's take a look at a chart of a stock. In this case, we're going to take a look at a stock called Syntel, ticker symbol SYNT. And this is a one-year chart. And it shows us, if we take a look in late October, it shows us how the stock price gapped way down from just under $42 to just under $36. So it was a $6 loss in one day, and that was the result of an earnings report, obviously a negative surprise. And you could see here that there was a tremendous volume spike as a result of the earnings report, and that's pretty common. You see a much higher trading volume when there's an earnings report announcement. So what we want to do then is say to ourselves, you know, if we're going to get a 6% return because of the increased implied volatility prior to an earnings report, exactly how significant is that if we're going to lose over 14% in share value? And now you could see why the implied volatility is not necessarily a positive. So when we take a look at a stock, we want to find out what is the date that the earnings report is coming out. And right now I'd like to highlight a stock whose ticker symbol is JOYG. And we take a look at earningswhispers.com and we see that the release date is December 16th, 2009. Now today's date is December 11th when I'm making this video. So this is a Friday and the earnings report is coming out Wednesday, and the options expire next Friday in 1 week or 5 trading days. So we would expect that the option premium under normal circumstances would be negligible because there's no time value, particularly for out-of-the-money strikes. But I want to show you how the increased implied volatility prior to an earnings report will actually change that. Okay, so let's go to the options chain then for this stock. Okay, so here we have it. And we see now that the stock is currently trading at 52.27. So we're miles away from the 55 strike with only 5 trading days left. But let's see if we can make any money selling the 55 strike. So we go down the strike column and we go across. And we see that the option premium is 85 cents or $85 per contract. Now I'm just going to run this on my calculator here. We get a return of 85 and we have a cost basis of 52.28, and that gives us a 5-day profit of 1.6%, which is an incredible profit if you think about it in just 5 days. And that's because of the enhanced implied volatility. Now if that price was $54, let's say, very close to the 55 strike, you'd have an incredible 1 week return. But once again, the risk of that stock going down is the reason why we can't be enticed by these very high option premiums prior to an earnings report. Okay, so let's take a look now at a bar chart here that I created. And the bar chart will show us, I did a hypothetical of a stock that we purchased at $38 a share. And historically, in a normal contract cycle with no earnings report, that stock will have a history of going up $2 or going down $2 in that month. So it can go as high as 40 and as low as 36. So if we buy a stock for 38 and sell the 40 call and let's say get a premium of $1.20, we've generated a little better than a 3% 1 month return, and we're quite happy with that. If the stock does go up to 40, then our return is over 7%, and we're really happy with that. Should the stock go down to 36, well, we've lost $2 on the share value, but we made $1.20 on the option premium, so our losses are minimized. Now, let's take a look over here. And by the way, this red arrow shows the upside potential of that. And if we go over here to the chart to the right, which is in green now, and it shows what if there's an earnings report coming out, how will that affect the share value? Well, the implied volatility is greater because the market is anticipating that stock can go, instead of up or down $2, it can go up to 46 or 48 and down as far as 30 because of the earnings report. Now remember, this purple bar shows us that the upside is capped at 40 because of the strike that we sold. So we can't take advantage of any further upside if the earnings report is a positive one. But the downside, we're at risk all the way down. So the blue arrow shows our risk and the red arrow shows our upside, and you could see that from the size of the arrows that the downside is much, much greater during a cycle that has an earnings report than one that doesn't. So you could clearly see from this bar chart the reasons why we need to avoid earnings reports when selling covered call options. So I think there you have it in a nutshell. The golden rule is to check the earnings report, and if an earnings report is coming out during a particular contract cycle, just avoid it, let the earnings report pass, then evaluate the stock again, and you can bring it back into your portfolio if it meets all of our system criteria. I hope you found this video useful, and I look forward to hearing from you. You could email me at alan@thebluecollarinvestor.com. And this is Alan Ellman saying thanks for listening. Take care, everybody.